My advice is don't make any change to your insurance policies. Don't even get a new quote. If you've got insurance in California, just stick with it
Just keep it.
because the act of shopping can cause you to have unexpected changes in your eligibility for either your current insurance or for the fair plan. So just
Wow.
if you've got insurance, don't change it.
We are starting to see some horrific financial numbers from the Southern California fires. I saw one report where the estimates are now over $250 billion, passing Katrina, which was horrific and traumatic for the New Orleans areas. I want to ask some simple questions. As a California real estate investor who has had multiple notes from insurance companies about refusals to renew, cancellation of policies, I just want to know if all insurance companies, like State Farm chose to do in the Palisades, are all insurance companies just going to flat out leave California and we're only going to be left with a now bankrupt California state fair plan? It does not look like it's heading in the right direction. And you know what? When I have a question like this, I reach out to the top. The CEO of Steadily is with us, Darren, and Darren, it's wild out there. It's crazy.
And it's only going to get worse, is the
Well,
bad
thank you
news.
for making me feel better. I kid. I kid. It's bad, right? It's pretty bad.
The short answer is in the admitted markets, we're going to see more carriers exit. This conversation is unfortunately going to have to be pretty nuanced in insurance terms to talk about what's going to happen. And one of the biggest nuances is admitted versus surplus markets. Admitted means the carrier has applied to the state of California with a specific set of rates and underwriting rules. The state takes typically a year to approve those rates, and then the carrier can only charge those rates until they get new approval from the department. That's called admitted. Non-admitted is when a carrier does not get state approval, but they also don't get the state backing from California. And what you've seen happen over the last 3 years is Progressive, State Farm, Allstate. I mean, the list is incredibly long of carriers that have pulled out. They're pulling out of the admitted markets because they have decided that under the rules of the California Department of Insurance, they can no longer operate in California, and so they're exiting. And what you're seeing fill the gap are the non-admitted carriers, the ENS or surplus lines. I have a lot of different names. But should you expect that your policy will get canceled if you are with an admitted carrier? There's a very good chance.
This is an important conversation because I was very clear with my audience. I think it was 18 months ago I started to get these first cancellations, or maybe not a cancellations, but refuse to renew notices, which means they would go through the term and not renew. Um, and that was problematic because you get one, two, three, it becomes a trend, and then probably about 6 months ago I had some hope. We had some changes in, I believe, how California was reacting in speeding up the approval process. It seemed to be going in the right direction. And then we just had the largest natural disaster in history, which is going to force more insurance companies just to give up. I mean, California has, I guess it's a state rule or something that makes it impossible to make a profit when the cost to insure goes up by 30%, but you're only allowed to raise it 3%. You have no choice but to leave. It's just mathematical.
The reality is that insurance companies are supposed to be there for a rainy day, and they can take a hit 1 year, 2 years, 3 years, 4 years in a row. But at some point, they hit a limit of the number of consecutive years that they can lose money. And in California, they hit their limit. They
Yeah.
had lost money for too many years in a row, and so they couldn't afford to keep running down into the negative. And you sort of see that happening in the FAIR plan as an example. So the FAIR plan had cash reserves of about $200 million, and they're facing liabilities of about $5 billion. Incredibly under reserved program relative to the amount of premium that it was writing. And they can do that because they're a government entity. And what the FAIR plan can do when they run a loss is they issue an assessment to all admitted insurance carriers that operate in the state.
Mm.
So even the carriers that did not have wildfire losses in Palisades are most likely going to be get an assessment that is in proportion to the amount of business that they wrote anywhere in California.
Oh my
And so
goodness.
even if you are an insurance company that is only writing in, let's say, San Diego, you are going to end up kicking in to pay for the losses up in the Palisades. And so carriers that are looking at their business in California are saying, even if they are conservative in their underwriting and manage to turn a small profit, they are likely going to be pushed into the negative by the assessments that they're expecting to come. And that's what's going to lead to this fallout of businesses leaving California, unfortunately.
Wow. So, I mean, is it a non-zero chance that at some point we are just all Californians left with the California Fair Plan? I mean, could it be that disastrous?
Conceptually, yes, but in practice, unlikely,
Oh,
because
whew,
what will
good.
tend to happen is that at some point the state would be looking at what it would cost them to foot the bill for these losses. And they would say, that's too big of a check. And they're going to ask the question, what do we need to do in order to get the private insurance industry to come back to California? And the answer is,
You have a lot of faith in the U.S. government or the California government. I'm not
I
sure.
have I have faith in voters and how they would respond to the amount of increase in taxes that it would take to
Mm,
cover.
that's true.
Uh, because if you look at citizens in Florida, for example, or if you look at the National Flood Insurance Program as examples of government-run insurance programs, these programs are phenomenally good at losing money. And there's no such thing as a free lunch. And so when a government-backed insurance company is losing money, it makes up that money by raising taxes.
Mm,
And so in California, yes, conceptually, you could move to a model where the only insurance company operating in the state is the FAIR Plan, but that would simply translate into one of two things at the end of the day: either very expensive plans under the FAIR Plan to cover their losses, or an increase in taxes. But there's no free lunch. Like at some point, the properties have to get rebuilt and the money's going to come from somewhere.
right.
And so I think that what would end up happening is over time, folks would say, what does it take to let private insurance operate in California successfully? And the answer is really simple. It's just approve rate filings in under a year. And then the
Yeah.
carriers would come back. They would set rates that allow them to make like a 3% profit margin is the typical profit margin for an insurance company. And they would come back and things would renormalize.
So let's play that out because again, I think you're right. And at some point, the voters wake up and just enough's enough, and going to only or even possibly getting close to only the California Fair Plan is it seems like a non-starter because they're just to your point would just increase taxes, no free lunches. But how soon do we get to that breaking point? Because again, I
It'll
think
take a
we've
while.
yeah.
I think it takes 2 to 5 years for these things to play out. So I'm not
Uh,
expecting a change in the next year. In fact, I think things will get worse in the next year.
so let's play because that's where my brain goes is it takes a moment for like an insurance company. It says I want to pull out California. That sounds like a board decision, ratified, done. It's over in 24 hours.
Well,
But
the
it's gonna.
decision can be made in 24 hours, but the at a bare minimum,
Mhm.
you have to continue to serve all of the policies through the term. So that's
So
a
you have to
minimum of a
run that out.
year.
So
And in some cases, there are going to be moratoriums where the
yeah,
carrier is not allowed to
okay,
exit the state. And so they first stop writing new business
correct.
and then they start non-renewing.
Mm.
But it takes a while. So you're talking about a multi-year process just for a carrier to exit.
So it takes a while to. So the decision is quick. It takes time to run out the book of business. However, me as a consumer, I will feel that immediately because I won't be able to get a new policy.
You will feel it if you go shopping for new. So
Right.
the so this is usually folks end these conversations by saying, "What's the advice for the homeowner?" My advice is don't make any change to your insurance policies. Don't even get a new quote if you've got insurance in California, just stick with it
Just keep
because
it.
the act of shopping can cause you to have unexpected changes in your eligibility for either your current insurance or for the fair plan. So just
Wow.
if you've got insurance, don't change it.
That's you heard it here, first, folks. If you got California insurance, just keep it. That's good advice. I would not have guessed that. That's wow.
I mean,
Okay.
normally I would be in the position of saying like, "Hey, come to Steadily and see if you can get a
Yeah,
better
of
rate."
course.
But the reality is, like,
Not
if
in
you've got good
California.
coverage,
Yeah.
just sit tight.
Yeah, I think well that's why you're here on the channel because you're going to tell the truth. And again, if you're in California, got good insurance, stay put's our advice. Um so if we look out over the next year or two, it's just going to be rough. I mean, I can't see how it gets better. It's basically got to get worse before it gets better. Is that what I'm hearing?
Yes, especially if you're anywhere near to trees.
Forest, yeah.
So
Okay.
everybody thinks about the wildfire area as the place where they see um, trees everywhere in the mountains. But the real concern is not the wildfire areas because the wildfire areas themselves, like the heavily forested areas, those don't typically have a lot of properties in them.
Yeah, there's not a lot of lodging there. Yeah.
So as a percentage of inventory, in the grand scheme of things, it's not that bad.
Right.
The real risk area is what's called the WUI.
Oh, what is that?
WUI, the Wilderness Urban Interface. It's where the
Ah,
forest ends, and then you've got this collar around it where
oh, okay.
you're abutting up against the forested areas. And that's what Pacific Palisades is. It's a WUI. It's the transition zone to wildfire. And so a wildfire
Right.
starts out there, and then the embers blow into the WUI, and you get this like house to house spread. So if your property is in the WUI, and you can sort of like look at a green space and imagine, am I within a mile and a half of like a densely forested area? That's the WUI, and
Mhm.
those properties are going to have a very difficult time getting coverage.
So it'll be so places that wouldn't be affected by this might be the Silicon Valley, those areas that we don't really have wilderness around us.
Urban San Francisco,
Yeah. Okay.
like middle of LA. But the
Right.
problem is that, and I've said this before, the way that the California market in particular works is that uh, the Department of Insurance is strongly encouraging carriers to not pick and choose areas where they will
Right.
write, and instead it's driving them to write the entire state. And
Mhm.
so if a carrier is saying, well, if I write in California at all, I'm going to have to write some percentage of business in these super exposed areas where my
Yeah.
potential losses are 500 or $1 billion. They
Mhm.
would say I would rather just not write at all, and that's why they exited.
Yeah, it's pretty wild. I am curious if this loss might be large enough where if you own, like if you own real estate in other states, you too might get impacted by rate increases just because, Allstate or whoever's got to, make up for the losses in California. Is that possible or no?
I don't think so,
Okay.
because the good news is that for the rest of the country, there's actually downward rate pressure.
Hmm.
So for the last 4 to 5 years, we've been seeing rates increasing. Those have largely propagated through, and we're starting to see rate decreases at renewal in some geographies. We're talking like a 3 to 6%
Wow.
decrease in some geographies. So in the rest of the country, it was looking like the worst is over. And I don't expect there to be a lot of spillover to the non-catastrophe exposed parts of the country. So if you've got a property in Phoenix, Arizona, um, that's a safe bet, right? Insurance there
Yeah.
is like 750 a year for like a $500,000 house. It's a very cheap place to buy insurance because very few natural disasters happen to Phoenix.
Yeah, I love that. So, unlike California resident, myself included, where your advice is stay put. If you're in any of the other 49 or maybe 48 states, if you take out Florida, I didn't realize that insurance is actually deflating. So it's probably a good time to go out to Steadily and say, hey, could I get a better rate if I'm in these 48 states? Is that reasonable?
That's reasonable. We'd love to have them come to steadily.com and get a quote, see if we can save you some money and get you a better policy built for landlords.
Yeah, again, Steadily, folks, if you don't know, on the channel, got their own playlist, purpose built for landlord policies. You see a link on the screen. Go there. Very easy to get a quote. My audience has seen about 50-50. About 50% of folks are getting better rates and better coverage. The other 50 are getting they're getting better coverage from where they're at, which makes sense. Some of you have your home and bundles and all of that stuff. So it won't be perfect for everybody, but damn it, 50% of you are getting better coverage at better rates. So it's worth a couple minutes of your time. Darren, any closing thoughts on this? Any hope for us California folks?
Um, very little in the near term. The thing I want to end with though is just we've been talking about the nuts and bolts of this from the perspective of us as real estate investors, us as insurance folks, but we have to acknowledge the incredible pain and suffering of the folks that have lost their homes and in some cases their lives to the wildfire. And this happens unfortunately with great regularity in California and other parts of the country. And we're so happy when we get to be a part of rebuilding the lives. Like that is the purpose of insurance, is to be there for these horrible moments, to get folks the money to go back and rebuild their properties. That's why we exist. And so it's two sides of this coin. On the one hand, we need to make sure that every insurance company is financially stable enough that we can be around for the next 100 years to pay all those claims.
Right.
But on the flip side, it gives us and our claims adjusters joy when we get to write somebody a check for $250,000 to go and rebuild their new home. That's why we do what we do.
Yeah, no, I think steadily in insurance companies. It's funny. We talked about this a couple of weeks ago. I had just had a fire inside one of my apartments buildings, and I could tell in real terms about the claim and about the process and the speed and all of that. And you're absolutely right. The claim adjusters that you reach out to, you get your claim number. They're there for you. They're looking to help. And it was. I think it was a $241,000 check, and now we're rebuilding the units and all very quickly. So that's a very nice way to end. We helping somebody rebuild is it's got to be heartwarming.
It feels great. We often talk about the negatives, but I also get to receive the thank you notes from folks who say, "Hey, look, here's my property 6 months ago, and here's what it looks like today. Like, thank you." And I get to get those, and those are the heartwarming moments that keep us going.
Yeah, I think that's just such an awesome thing to end on. And again, it's really funny. You said something earlier that I want to go back to because I think it's important. A lot of just people out in the ether just think insurance companies, these big greedy, whatever. But you guys operate on roughly a 3% profit margin, right? And you're taking on huge risks, the entire insurance industry, and you're there for the catastrophes, and you come through. So yeah, folks, if you are in 48 of the 50 states, not Florida, not California, I suggest reaching out to ORaaT.steadily.partner.com, because I just learned that insurance is going down. Go get yours, see what's what. Darren, thank you for being here.
You're welcome. Glad we could help.